Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you this week's Strategy of the Week update for January 6, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Quite a wild day we had here for row crops, particularly the soybeans. When I say wild, we've traded both sides of 20 cents up and down here. That's the wrong way of saying it. I guess I should say we traded this 20-cent range 4 times up and down here throughout today. We'll take a look at that in just a minute. Let's start off with our daily chart. The daily soybeans in the March contract, we got to be aware we're bouncing, or we've come up into, I should say, this old area of resistance from last summer. It's certainly our old contract highs and this fabled $13.80 to $14 area that the market needs to kind of go through with some vigor here. Otherwise, I fear that we run the risk of falling off from this level like we haven't seen in the past. We don't have, a really low liquidity holiday weekend like we saw with that almost limit, or was it a limit down move? I forget. I think it was limit down for corn, almost limit down there for soybeans. It was a wild day, right? Back on July 6th, coming out of that 4th of July weekend. But every other time we went up to $14, we got rejected, and we did fall, 80 cents off that area every time, 60 cents then off the, 1370 rejections until we eventually fell down to test that $12 area. We decided we wanted to remain above, the market did, and we've rallied back to beans in the teens and up to $14. Now, trendline support against the lows here. I am watching this trend line drawn from the 1214 low through the lows of last week. We came down to test that as support here in the overnight session around 1270. We bounced. We had a pretty good close for the day, even though we were down 7.5 cents. That November 22 soybean price, 1306 right now, that might be the tell and the canary in the coal mine right now that we'll take a look at here today. Are the November beans starting to now decide that we can go higher? Now that November beans, new crop beans, are beans in the teens, that's going to allow, in my opinion, the March contract to go being crazy. Holy frijoles, rocket ship type of move. The inflationary environment we have, coupled with China, only committing to going hand to mouth, if there is that greater fear of not having beans in the future, we're going to see this market continue to trade in an otherwise non-carry market. All right, so 200-day moving average is down now around 1305 for the March beans. 100-day moving average and the 55-day moving average about to give us that bullish crossover. Look out for that. The last time we got that was back in July of last year, and the market never really looked back, all the way up to 1450 highs. The last time we had that bullish crossover. So watch for that event here, that golden cross. For all intents and purposes, a good indicator. That 18-day moving average down at 1331. I wouldn't be surprised to see it get dragged up a little bit here as the beans maybe go sideways. Again, this trend line here in the 18-day moving average, I think will be supportive now on any other move here for the soybeans. So last week we took a look at the beans and decided we had kind of an end of the year recap to do on them. Today I want to discuss just very briefly this from the 4-hour perspective, this trend channel we have going to the upside. Again, kind of defined by that trend line support we just looked at there on the daily chart. And then, upside to this in this trend channel or trend channel projection would take us towards 1420 to 1440 at this time. Sorry, let me get that chart up for you. There we go. So there's your channel here since our December lows. I'm going to remove the channel for a moment just to be able to see what else is going on, and I'll draw these other fibs up here in some of these other things we're looking at here in just a minute. But I wanted to at least point out this highs to highs extension. More or less we had an attempt at holding a 50% retracement here off the lows when the market started its trend here for December. That 50% line arguably, maybe defended these 61.8 or traded either way, this expanding flat. The market then went to its negative 23.6% line But after it traded that 23.6, it just broke out. And that type of breakout from that first technical target suggests that the market will sometimes do this high to high extension pull. Support was down around 1331. We didn't quite get there, but nevertheless, we're now swinging up towards the 1409 potential upside target from that. And again, it extends towards 1450, which I think is a more likely target for the beans at this time. Full 50% retracements. I don't think it will happen, but if it does, the swing from 1193 up to 1397, it's important to point out that that $13 mark is now the 50% retracement of this entire rally we've seen for soybeans. Now, March beans above trendline resistance here. November beans, 22, new crop beans above that trend line too, when we looked at that chart just a minute ago. So this all feels like the beans are breaking out. When we look at meal and oil as well, we see some strength in those markets. You can see the March, pop those daily charts up real quick for us. We're also going to look at some of the WASD numbers for next week potentially here before the end of this report. We'll get that going here in a second. Okay. So soy meal, been in quite a trend since October as well. It's continuing higher here. I was, anticipating maybe a pullback towards and a dip below $4 again there, back towards the 18-day moving average. It's just not happening. So 200-day moving average around 360. The 50-day and the 100-day moving average already gave us a bullish crossover there. We are no longer in overbought conditions for soy meal, so I see no reason this market can't continue its trend to the upside. But again, pullbacks here and finding, the market entering periods of price discovery and finding support are not out of the question. But this is definitely a meal-led rally, as you can see from this day chart of the meal. Soy oil coming out of the low end of its range and trading back above all of its daily moving averages here over the last week as well. It too is, fighting to get that 55-day to move back above the 100-day. The 200-day moving average has at least started to slope positively here, and the 18-day moving average has started to turn up here. So, I think oil too is poised to break out of a range that it's been in. And if we've got both, oil and meal breaking out to the upside, well, that to me justifies, the underlying value of soybeans or price of soybeans going higher. You've got crush margins improving. That justifies, dragging up the price of soybeans here. And I think it's outside the last year where we had really a fear of a lack of supply and that strong Chinese demand-driven market. This year we have a true, oil and meal driven rally coupled with a lot of the factors we saw, from last year too. So I think, or adding on, then on top of that, all the inflation, the general, broader inflation trade that's going on, creates for a very interesting dynamic, which again, last year we saw China already paying domestically $20 a bushel for soybeans. So, the end user here at the end of the day is has already paid that type of price here in the past. So they're prepared, their wallets are prepared for it psychologically at least. All right, so soybeans trading wise, let's get back down to the 4-hour chart. And then we'll take a look at maybe get down to the even smaller time frame now, the 15-minute chart. We're starting to break out of that downtrend that we had from last week. We started a pretty nice uptrend, it felt like there this week. We are definitely higher on the week. If you can see from Sunday's open gap here, we are over 40 cents higher still today. Today we've traded both sides down 20 cents, up 20 cents, down 20 cents, and back up 20 cents, all swings within today's price action. Pretty impressive. But the market, moral of the story is that we still closed today. So 2 days in a row here, we've closed above, in my opinion, above this December high. That's brutally important right now in terms of how this price action has been. 3 days in a row, we've closed above December's high. So that, to me, is at least promising for the short term. I actually would have preferred to see the market trade all the way down into the 366 area. That would have been a full 50% retracement off of the day's highs. I'm a little worried it might still, because if you take the 13.99 high to the 13.70 low here from today. Extend that from the high, that measurement, that 100% of measurement is down around that area too. So, if we get down there, I'd be interested to see what the market does. But the fact that we already got such a strong reaction off the 1370s, I'm a little fearful that if it goes there, you may not want to be a part of it. Bit of a channel here forming as well. Fix this channel for us. Some kind of channel, trend line, whatever you want to call it. There's a little sloppy here somewhere, something like that. Has formed as well. Remember, we're inside that much larger channel, heading higher. So there's multiple degrees of trend here that could be pulling the market higher. The 15-minute time frame, this was a lot of noise today. It was not a trend day by any means. Today was definitely a counter trend day. But the way we settled the market means that I don't think the bulls have given it up yet. And if we do fall down and fall through, certainly below 1375, 1370 lows of today, if we don't hold this 65 to 60 area, we run the risk, I think, of falling all the way back down to 1330 to 1340. So be aware of that. There isn't much in terms of that this market has proven to us outside of this range that we've been in for the last 2 weeks. But I do think this is how or what a market looks like as it's trying to break through a key figure like $13. And if we reference another market that broke through a key figure and what it looked like, let's look at corn. Corn took forever to break through $6. It even went above it here at the end of December and fell back down below it, only to climb back up above it here this week and trade and settle back above it here today. Which is good news for March corn. Let's take a look at that daily chart, and then we'll break down the smaller time frame here, that 4 hour and what have you. Okay. So 200-day moving average here for March corn coming in at 559. The 100-day at 563, 55-day at 582, and 18-day up at 597. So you've already got that bullish crossover from all of these moving averages, and the market is proverbially trending higher. You've got a couple supportive trend lines that we could draw through some of these lows here now. They come in down around 597 at this time, 595. We've got that 18-day moving average, which seems to be a magnet. It's like every day that the market wants to do a pullback, it will quickly test down into that 18-day moving average, find it as support, and then continue higher. Sometimes we get a multi-day break below it, but we ultimately always find our way right back above it here in this uptrend. We are through trendline resistances, just like the soybeans, no matter how you draw them on corn. So for all intents and purposes, we had a trend into this year, we had sideways consolidation, and now we have a trend breaking out of that sideways consolidation, creating the potential for a much larger swing higher, which is the point to take away from here. Arguably, corn really broke above $6, which is the key figure I was alluding to before, or at the start of this this corn diatribe. I just want to put a box on the market here around $4.90 to $6. There we go. You can see it as resistance, 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 breaking through, pulling back support, support. Probably support a few more times before inevitably, and in my opinion, continuing higher, getting up towards the 640 highs and continuing onwards. So let's go to that 4 hour chart for March corn and take a look in a little more detail what's been going on this last week since we spoke since last week's price action. Okay. So pretty choppy, but still a progressive trend higher. All the major swings up are met with pullbacks that find higher highs and higher lows. This latest swing in December ended with the market breaking above $6 and pulling back. We were trading and had been drawing up this 50% level couple ways to draw it, either from the 562 low or this 557 low. Either way, 587's 590 area was that 50% line. This is also trend line resistance. If you draw the trend line from the 640 highs to the 632 highs there back in May and June respectively, kind of went through the highs here in December and November. We broke through that trend line. We came back to test it as support. The last 4 days of consolidation that we saw before this last week and into the end of the year, a little bit of a pullback. That break through $6, pull back to test the support. Okay, we ran through a little bit in low liquidity holiday markets, but we are ultimately in 2022 here starting off by trading back above $6 rather quickly. We had a trend line resistance against the highs that yesterday, or on Monday I should say, we rocketed through. We then pulled back to test that trend line as support. And by the way, this last week we traded full 50% retracements off the highs. You can see how it went up right through the 50, through the 61.8 line, nobody home, and then immediately after that the market pulled back right into the 50% 598, or what I refer to as an ambush long. So the market effectively pulled back 50% to start the month of January. This swing higher, as long as we're above 595, really the 596 lows of today, I see us heading towards 617 prior highs. That will take us very likely through the highs and onwards towards larger targets, which again, from that larger 50% that is drawn from 557 low to the 517 high, that 50% pullback into 587 here, that's got upside targets of 631, which I don't for 1 second deny the market could or should get to. I think it's definitely in the works. All right, so now I think it's also important to start watching, some kind of channel here, or looking for the channel, or channel / trend line support, because it's going to be good to watch, or continue to watch, and help us project as the market moves higher. But corn really hasn't had a prolonged rally here in some time. It's been very choppy, very sideways. We haven't seen moves like we saw last year that took corn considerably higher, through the end of the year. For example, here, this, if you look on the little chart there on the screen, from 460 up to 640, that move from April to May, that was a true breakout type move. I have a hunch that this price action we're seeing here is the buildup from September to January here. Let me just make it bigger. Is the buildup like we saw from November through March here. And then all of a sudden, boom, you get this big explosion. I think we're building up, and maybe we'll get that big explosion. If not, if we break down, we know we're in a larger range for corn. And something we've been talking about with lots of our clients is that, hey, these pushes towards $6, above $13 to $14 for the soybeans, great time to be looking at doing some cash sales. There's plenty of re-ownership opportunities on the board. We talk about them time and time again, and a lot in this video. If you're not, one of my clients or working with me, and you're not already long the market, you're certainly getting some opportunities and some ideas to do so here, with finite risk, which is, of course, that key component to why and how this becomes a better financial decision for you than holding the cash in the grains in the bins, perhaps. Okay. 15-minute time frame, we saw that 4-hour chart there traded at 50% pullback here. Corn now on the 15-minute time frame in intraday today, we rallied up and broke above that full 50% swing off the high, and that 61.8 line. So that's a good start for this rally. We hit that 61.8 line. I wouldn't be surprised again, corn to see. Watch the 50% pullback from today's low to the high. The $6 area is probably going to be supportive. Watch for trend line support now, and a channel to be derived from here. But I do think we could see the market head higher from here, given the price action we've had. Now, also, before I forget, there was a gap here on corn at 590. It's very similar to that 1440 area for the beans. Something that we're going to have to watch from here from last Tuesday. Yeah, we'll see what happens. Okay. but that could be a runaway gap here that occurred there between Monday and Tuesday that we haven't had a chance to talk about. But staying away from that 590 area at this point in time is would be pretty good for corn, and of course going through highs. And last but not least, now we've got a little bit of trendline resistance across the highs here. Watch for that break of that, a breakout of that trendline resistance now for corn against the high, and that's just for the month, highs of the month through the highs of yesterday and today. A break of that probably will send us towards 615 and 660. So we'll see. So wheat, kind of like last week when I didn't have much to say about wheat, and I'm fearful that we're in a larger pullback for multiple reasons. That pullback seems to be related to not only U.S. dollar, and currency moves, but also just generally wheat being overvalued relative to the global market. U.S. wheat prices, spring wheat hitting over $10, KC in Chicago hitting over $8. Those prices really take away that demand from the global picture. There's plenty of other wheat markets around the world, and if our wheat is just priced out too expensively, it's just going to price itself away from that demand. And the perfect answer for a lack of demand is lower prices. So that's what the market's doing right now, in my opinion. Outside the fact that we were technically, had good reasons to be, the market was fading. It fell through key technical levels. It found through trend lines, had held 50% shorts. It's heading to targets, all this good stuff that started a downtrend. The fundamentals were still pretty bullish in wheat. We have really tight carryouts. We've had bad weather markets. We've had weather markets here throughout the winter. But generally speaking, our export market has dwindled away and has been, seen the, for lack of a better term, the fathom of high prices, right? So let's the cycle is really still corn and beans related, but nevertheless, we're starting to get down into levels for wheat that might be value. And when I say that, I mean we're oversold now in our daily RSI. We're traded down into that 200-day moving average at 730. It's a big 50% retracement for wheat. And we're also arguably trading down into some larger kind of trend line down here, depending on how you draw it. But somewhere around $7 to $7.30, I would put that other trend line and an important level for us to watch. As that's been one of the levels that as we broke through 7, we came back down to test it, broke through it again, tested it, broke through it again, tested it again. So $7 is for whatever reason an inflection zone at this time. The 18-day moving average has now moved below the 55-day. The 55-day is still above the 100 and the 100 above the 200 here. But Chicago wheat having a pretty big sell-off. This downtrend, if you look at this how it's cycling through, it's very reminiscent of the sell-off we had from 772 back in May of last year to the lows of July at 662, 626. So that's a $1.50 sell-off over the course of 2 months. We started this sell-off here at 874. A $1.50 sell-off would be down to 725, and 2 months would put us, basically at this, towards the end of this month and into February. So maybe we have a little bit more downside on wheat. We definitely had a bit of a bounce today into the close, which I was not paying, I'll be honest, I was not paying much attention to because I was so fixated on corn and beans today. But nevertheless, Chicago wheat getting a nice recovery. Actually, all the wheat getting a bit of a recovery into the close, but still closing down pretty dramatically. KC hard red winter, very much like the Chicago, but it's well above its prior highs here from May and July still. So interestingly enough, it's good to see that protein premium come back into the KC wheat. We'll look at that here probably a little further. But then Minneapolis spring wheat now breaking down below its 100-day moving average and its 200-day down around 871, which I have no doubt it could get down to at this point in time. Probably wildly overbought there for the Minneapolis spring wheat while we were up around $10. I thought this sideways range would be conducive of continuation higher. It wasn't. It suggested that we needed to now pull back further, or the market has pulled back. And we'll see how far down the rabbit hole it can go. Again, 200-day moving average around 871 happens to be around our old supportive, I guess congestion zone $9 to $8.50. So I think we're going down there to test that at this time. Let's take a look at that Chicago wheat though on the 4-hour chart here before we get too far into this. And I do want to go and cover the hogs and cattle here today as well, particularly that hog strategy we looked at last week because it was kind of a complex option strategy that had it's been the way it's performed has been pretty interesting. But more importantly, the exposure it gives to you is interesting, and I think looking at that is important to better understand options. So the full 50% retracement from our 626 lows to the 874 highs here at 751. We had a bit of a double bottom starting to form there. We had a bounce there to start the month. We've now broken below that level. It doesn't feel like this 50% is going to hold. I'm actually going to I was going to delete it. I'm going to leave it on the chart, I suppose. All right, fine. There we go. Because I want to really highlight the full 50% short, the 874 high to 751, that 50% at 813, because we seem to be trading down towards its negative 23% target down around 722. This does look like an A, B, maybe C wave lower if this is 3 legs lower, but it also could be the start of a much larger, bigger pullback, and that's something that you just never know until it develops. But equal legs down would be down around 701. So there's some pretty good technical fibs, a reason maybe find support around that 750. There's also now a downside target around 721 and 100% extension down around $7, which interestingly enough is also the full 50% retracement from 530 lows for March wheat all the way up to 874. So could we get a move down to $7 to test both trend line, that bigger sloping trend line, a larger congestion zone on spring wheat, to test below the 200-day moving average, to test a 50% retracement and equal legs down? I don't know. There's a lot there that says if we get there, I'd be interested in maybe doing some reownership and being a buyer there, particularly for any bushels I sold over $7 at this time. But that's something to consider and think about if we get down there. I'm not in the mood to catch a falling knife, but it does feel like wheat has a little bit lower to go here before a bottom is truly in. And I do think it's going to decouple itself from the rest of the row crops right now because we really are kind of in the spirit of, for the row crops, kind of in the spirit of the corn and bean acre argument beginning. So with that being said, let's move on to cattle. I think wheat is going to be a continued dialogue, but well, I guess before we do, let's okay, Dan, what would you look for to start positioning again in wheat? Well, as we're heading down into support, I'd be very interested in what this leg down is doing. The trend that began from 824 and is still heading lower is still intact. This is lower lows and lower highs every day. There's a downward sloping trend line against the highs that defines that trend pretty well now. I would wait for a break of these downward sloping trend lines, coupled with a reaction from a particular supportive level I'm looking for. Then I would go and confirm that daily RSI and other things are oversold and reasons to think that the market might want to revert to a mean, in other words, reverse, and see profit taking. Then I would also consider where in the cycle are we. If we're in the middle of a month, I'm a lot less inclined to catch a falling knife or fade a top. If we're at the beginning or the end of a month, I'm much more inclined to take that type of risk because I believe it might mark a higher low for that time period too. So all those things would go into my consideration. The fundamental picture is still bullish wheat in terms of our tight carryouts. Now that we're getting down into prices that might encourage demand, I can now re-enter with that narrative that down here, that demand would be there for wheat. Because even if you have tight supplies, if prices are too high, you could still have a lack of buyers and a lack of demand, meaning a downtrend in the market's price would ensue or could ensue. So yeah, we'll see what happens. But I'm fearful wheat will weigh on corn prices for a little bit here. But let's not forget how far that wheat to corn ratio or corn spread move here in favor of wheat. Well, maybe corn needs to do some catching up here, and I think it's high time that it does. All right, so cattle, pretty quickly here. And remember, guys, if you missed If you missed this meeting, don't worry. Or if you're late to it, I will be sending out the email with the recording here momentarily. Live cattle, little disappointing to see the downside we did over the last couple of weeks, or a couple of days, I should say, because looked really like, and I'm looking at the Feb. This same idea could be applied to any of our calendar contracts right now. It's just the Feb happens to be a front month future. It looked like we were gearing up for a breakout of that, those highs, the 140, 142 area here for Feb. April was a little higher than that. It's no big deal. It's water under the bridge and what price exactly it is. But the point being is that we had that 55-day moving average crossed over the 100-day moving average there back in early December. We've been above this 200-day moving average at 135. The market got a good reaction and a positive close on the day today. We are holding this 100-day moving average at 136.20, and we have been ever since we got back above it there in October. In fact, we were above that 100-day moving average for the entire rally. We even came down and tested it once here back in May. We broke below it momentarily to test the 200-day moving average, but then quickly rallied back above the 55-day and the 100-day moving average. There was that fake out death cross where the 55-day moved below the 100-day, and the market quickly rallied above. Now that we've kind of worked out the kinks, if you will, if the market stays above the 100-day, and particularly can get back above the 55-day here at 137.80, 18-day moving average is 138.20. We'll be pressing against the 141 highs here rather soon, which to me makes for an interesting, the ability to enter into now an option spread strategy in the cattle is there. I was looking, and I've been watching the 138 to 142 call spread in the February cattle. This is one that was in before, I've gotten out of since then. I still kind of like it because, again, this is a option spread that, let's take a look at that chart real quick so you can take a look at why I pick it here. 138 is basically in the money. It's a little bit higher, but 138 is above the, we spent the majority of the time the last 2 months above 138. Majority of those days. And if we're going to break out and go higher, great. Now, 142, we've spent all of our time below 142. So I'm, more or less looking here into the end of the February contract. If I'm going to take limited risk, I'm betting that the market's going to end up somewhere in this area. I'd love for it to go higher. It wouldn't hurt me if it did, but I have the finite risk. I think being long live cattle here with stops below 135 or even below today's low of 136 in the Feb contract is not terrible idea, but this is a way that you run the risk of having a stop slide down to the 200-day moving average before a springboard higher. Using this 138, 142 call spread, you might be able to tighten it up a little bit. Is one way of going about that. So let's take a look at how it prices out real quick, because I do want to look at the lean hogs for a moment too. Help if I didn't look at feeders. Live cattle February contract, 138 calls here went for 137.50, or excuse me, 175 here into the close. You're spending 55 here for bringing in 55 for the 142. So all day you're 1.2 or what's that, $600 out the pocket for the potential to make. Let's see, what's 400 times $4, right? To make $1,600. So not bad in terms of how close to the money the option spread is. And again, that 55, that half a point you bring in for the 142s, that's just protecting against some time value and really protecting against a third of the premium you've got in the 138 calls, if that's something that ends up being suitable for you. But nevertheless, I do think the cattle market is due, if it can hold this 100-day moving average, is due for a move back up inside the range and back up to potentially highs. And February lean hogs, very sideways price action, very range bound. We've been in consolidation here for months on end, but we could be coming to the point where that consolidation needs or wants to end. Where we held our 55-day moving average, I suppose you could call it that, on this pullback here now that we tried to trade above it. But really, I think we're trying to break out of this range and break out of some form of the trend line here that's being drawn against the high. So every time we get beaten down, we come back up to retest it. Whoop. Switch the scenes there on us. Okay, we were getting a bit overbought there in our lean hogs through the end of the year. As you can see in the daily RSI, this pullback reset that indicator altogether and has now given the market a little bit more gunpowder to be able to run through and break out without being overbought, which is a pretty bullish sign if you ask me. Now, last week we took a look at a 92, buying the 92 call. We were buying 2 of those because the idea was we wanted a strategy that effectively was profitable and we were also looking at April here, so in this strategy. So just bringing up the chart of April real quick. Pricing's more or less the same. It's just April's actually breaking out a little bit, I guess you should say. It is that's an interesting dynamic here today, is that April lean hogs are breaking out of that trend line, leaving February behind. But point was that we were looking for a strategy that if it went above and broke out of this area, you could make money to the upside. But if it stayed in this range through April, you'd still make some money. Not a ton, but you get paid almost twice what actually there's a credit spread. But point being is we were using the 90 call. We are selling a 90 call for horizontal line there at 90. We were selling an 83 put. This is all from last week. And then we were also buying a 92 call in case we broke out. We take pretty much everything else off this chart, so you just really concentrate on those yellow lines, because those are the only yellow lines that mattered for this strategy. Selling the 83 put means that if the market goes up, you make money. Selling the 90 put means if the market goes up, you lose money. So those two would more or less offset each other. The only difference being is the $90 call that you sold has unlimited risk. The way to negate that risk is by buying a $92 call. And you do have a little risk between 90 and 92, where you could lose a little bit of money. But if we start going above 92, you quickly become profitable again, and in fact have infinite upside potential above. Now, if we were to fall down and go down to 83, so long as you're above 83, you're still making, the way the strategy worked out, you're still making and bringing in a profit. Let's take a look at how the P&L worked out, and I have the prices locked in for what we were doing them at last week and what we were looking at. So that the $92 calls, those were costing us 3.125. Quite a bit of money to shell out of the pocket, to buy a call that is, that far out of the money and to break out of the highs. But we're financing it by selling and buying 2 of them. So that was 6 cents out of the pocket. We're financing it by selling a $90 call for $4.05 and an 83 put for $3.05. So if we take the 92 calls out of the equation, there you go. This pricing, you can see how you'd make around $3 grand, so long as the market stays. I'll put the market right where it is. This line, I'm going to put it right where we are at 89. This line, I'm putting where the market, our one strike at 90, and this marker I'm putting at our other strike at 83. See where I did that down here? So one strike, if we go below 83, you start to incur unlimited potential losses. If we go above 90, you'd incur unlimited potential losses. This is what we refer to as a strangle, and we hope the market stays between those 2 strikes. And this is if you had sold the $90 call and the 83 put in a 1-to-1 ratio. Ignore the $92 call that we had put on initially. This would bring in a credit, though, to your account of almost $3,000 initially. But the problem is unless we close on the April expiration between those 2, you don't get to keep that money. And the green line here is the theoretical, if we closed out on the expiration date, what the option would be worth. The purple line here is the current value of that option expiration. So this purple line will slowly move and creep higher, increasing its increasing that angle, so to speak, to fit this other curve closer to expiration you get. Now, once we throw in the 92 calls that you buy, boom, the general shape is the same around those two strikes. In other words, you're still profitable so long as you're above 83 but below 90. You bring in this case, you're only bringing in $480, and you can see down here I'm reading, the 480 you're bringing in is the total premium for selling those two options, plus then spending some again to buy those 92 calls. Then once you go above 92, you actually dip down and you have the potential to lose as much as $300 there if we close right at 92. But then everything above 92, you start to gain that back, and you can, in theory, make an unlimited amount of money if the market continues to rally. Now, you do have to be aware that this market does have potentially unlimited losses still, but by selling those options, we actually we bring that potential loss, that theoretical loss, down to an 81.80-ish area, where so long as we act before 81.80 to offset that short put, that short 83 put, you can cap those those losses and keep them from being potentially infinite. So that's a good thing to do. All right. Well, with all that being said, I wanted to at least go over how that kind of strategy played out and what it's looking like now. You can see that the curve that this strategy would price in real time, last week when we were putting it on, we were down around 88 in the hogs. Now that we've come up, the strategy has, in theory, made about $400, but that's neither here nor there. It'll actually start to lose some money now that we're going above 90 in April hogs, which is an interesting thing, is that now that we're breaking out above 90, until we break out of 92, the strategy I presented last week is actually going against you or us or what have you. But we're now looking for the market to really break out, or if it doesn't and breaks down into its range it was in, we're okay, we're protected. We know the strategy can make money that way too. So very kind of interesting trade that I want to continue to follow here going forward, because it is a complex option strategy. But as you can see, with options, you can truly fit any type of strategy to fit exactly what you think a market has the potential or might be doing. So yeah, with all that being said, everybody, I hope you enjoyed this week's Strategy of the Week webinar. It was quite a wild day here for corn and soybeans, particularly for the bean market. It seems like we are in a market that's building up potential energy for a very big move. I think that move is coming higher. It seems like it's starting to prove itself to us. Today's pullback, the further you pulled it back, the further the rubber band may fly, as they say. So we'll see if that continues to be the case here going forward. Have a great day, everybody. Have a great rest of your week and a happy weekend in case we don't see or talk to you. If you want to check out more of what Zaner has to offer, shoot me an email. Send us a message. Give us a call over here, 312-277-0110. We're always here to talk with you about your trading strategies or marketing plans, what we think the market might be doing, and how to best help you and your business manage its risk. Have a great day, everyone, and we'll be back with you as price action develops.